Good morning. You're watching live market outlook for Monday, 6th of February 2012, prepared by Windsor Brokers. The dollar kept its positive tone after unexpectedly strong US jobs data, pushing their major counterparts, euro and sterling, slightly lower, as well as gold and the energies. As I said, surprisingly strong data brought investors back into the greenback that is pushed off its recent lows. The single currency remains under pressure as the renewed focus on Europe's banking and debt crisis may quickly erase the recent optimism about global economic prospect that followed Friday's remarkably solid U.S. employment report. While the U.S. jobless rate fell to the lowest level in nearly 3 years, the Eurozone unemployment has climbed to 10.4%, its highest since before the adoption of the euro. Also, China, another key engine of growth, is hitting its own speed bumps as it faces a rocky real estate market and high local debt levels. Curiously, the better U.S. employment outlook might deprive the global equity markets, which have been a source of strength for economic activities, of a key recent impetus for continued gains, the prospect of another monetary easing from the Federal Reserve. Global investors could be in for a bit of a hangover from a post-job report surge in stocks that pushed the Nasdaq to 11 years high, as attention turns back to the prospect for a Greek default and chances of contagion beyond Europe. As the economic data calendar thins out and the world turns into its focus back to the Eurozone financial debacle, there is a little reason to hope for a decisive resolution to the two-year ordeal. Even basic scheduling has become a sticking point in Greece's negotiations on a debt restructuring with bondholders. On Friday, Jean-Claude Juncker, head of Eurogroup finance ministers, said officials would no longer be meeting on Monday as previously expected, but might do so later in the week. Despite some positive data from on the Eurozone's service sector and the big effort by the European Central Bank to keep bond markets treading water, there is still plenty of signs of gloom for the European economy. Many analysts worry that policies aimed at fiscal austerity have been pushed too far and will stifle economic growth and lead to a cycle of stagnation and higher indebtedness. As mentioned, Greece comes in focus as today's scheduled meeting has been postponed. However, the deadline is coming. It was due to be today. Still no firm agreement reached, and the risk increases of possible worst scenario and messy default of the Greece will be closely following a development of the situation in Greece. Now a quick look on today's calendar to see what we have. Actually, usually Monday's very thin calendar. Retail sales from Australia came during the overnight session, negative result minus 0.1 compared to 0.2% forecast from Eurozone investors. Confidence is due at 9:30 GMT, and slightly more positive forecast from the previous release of minus 21.1 with today's consensus of minus 14.8. German factory orders monthly are due at 11 o'clock GMT, and the improvement is expected compared to the previous month of minus 4.8%, with today's forecast at 0.7%. From Canada, the last of today's PMI due at 1500 GMT. IV PMI 58.6 is the today's forecast compared to 63.5 of the previous month release. Now, a quick look at charts and to see what were the movements in from the Friday and what are the outlooks for the coming days. As we can see, the euro's short-term rally from a lows of middle of January is so far been limited by daily Ichimoku cloud that keeps the downside pressure, that keeps the price actually limited as the pair hit its highest level at 132.32 on 27th of January, and since then it continues to move sideways with the picture still turned more to the downside and keeping the pressure at our key supports at 130.25, 130.00. On the daily outlook, the pair is still holding, the studies are still holding positive structure. However, it started slightly to turn lower, and the direct attack at 55 days moving average seen today and Friday, currently at 130.78, might risk further easing of the pair after hitting fresh high at 132.32, as 90 days moving average keeps the upside limited for now. On the narrower time frames, easing from 132.32 high still keeps the pair in the directionless mode, moving within 130.25 and 132.32 range. Initial attempt to build the base at 130.65-75 zone has failed, as the pair overnight and this morning broke lower, also with the gap lower opening in the Asian session, keeping the near-term focus to the downside. 20 days moving average on 4-hour chart currently at 130-135, where was approximately the closing price of last Friday, limits the upside for now, with the direct focus at 130.25 low of 1st of February, and Fibonacci level 38.2% of the short-term uptrend from mid of January until until end of January at 130.00 would be seen as the next target. However, loss of 130.25 and possible attack at 130.00 might signal end of near-term range movements and consolidation of the short-term uptrend, and might signal also stronger correction that would keep the recent highs at 132 and 132.32 out of reach for now. Holding above 130 and even better 130.25 might keep the hopes of fresh strength alive, and break above 132 is required. That this is repeated attempts that failed at this zone is required to open way for a retest of our key near-term barrier at 132.32 and possible extension higher. For now, the pressure remains skewed toward the downside, as I mentioned, as the main bear trend line drawn of 132.32 and connecting previous highs with a couple of fake false breaks higher, keeping the focus downside. Also, the negative fundamentals that are developing in Europe, mentioned previously in our fundamental part, are putting additional pressure on the single currency, and the loss of our key supports at 130.25 and 130.00 would likely encourage sellers for further descent of the single currency against the US dollar. The cable is also at the back foot as its near-term price action sees the easing from 158.81 recent fresh high posted on 1st of January, after pair broke some significant levels at 157.70 and 158.00, extending its short-term recovery from 152.33 low of 13th of January, after it broke its significant support and the medium-term range floor at 154, 153.60 zone. Currently, the pair is easing with the recent low false brief break below the main bull trend line, hitting 157.50, where currently the pair is attempting to base. This is also around the trend line support, and the reversal above this level would keep a short-term bullish structure intact and see the current movement as consolidation correction, while loss of 157.50 might risk further easing and the possible test of next strong support at 157.00. On the Fibonacci levels, also just below 157, loss of 157.05, low of 1st of February, risks further easing towards 156.50 and 156.35, where is 38.2 Fibonacci retracement level. On the upside, reversal, as I mentioned, the reversal above 157.50 or 157 would keep the short-term structure intact for a fresh attack higher. However, it's at this point break below this triangle on the hourly chart might risk further easing, as the studies, hourly studies, are negative, while 4 hours also are lost momentum actually, and still pointing lower. Daily outlook keeps the positive structure in play, with the current pullback seen corrective as long as 90 days moving average currently at 156.76 holds the downside, and the reversal above here to keep the scope for a fresh extension higher. Clearance of 158.81 previous high to open next very significant dynamic resistance, 200 days moving average on the daily chart. Dollar yen is attempting to hold its recent gains after upbeat US data last Friday, when the dollar strongly bounced higher, and the pair is now attempting to keep the base at 76, the recent lows intact for a possible fresh recovery. A regain of 76.50, previous strong support, now previous strong resistance, and now reverted to support, as the pair tested the next level at 76.75 zone, just ahead of 76.89, 38.2% Fibonacci retracement of the latest decline from 78.27 down to 76.00. Holding above 76.50, current pullback, as the overbought hourly studies suggested the correction is seen positive, and it might keep the focus higher, might support the pair for further extension. Pardon, regain of 77 as figure resistance, and the levels at 77.13 that marks 50% Fibonacci retracement of the entire move, and 77.40 would confirm the bottom at 76.00 and open way for a possible fresh strength. However, it's a significant break above 77 would bring the pair back to the previous range and averting the downside. Dollar Swiss on the near term is in recovery mode after again strong dollar boosted by US NFP data pushed the pair higher through 92.08 and 92.27 previous resistances, heading towards our key near-term barrier at 92.50 that marks also 38.2 Fibonacci retracement of the down move from, I think this is wrong. Okay, pardon, towards 50% Fibonacci retracement of the down leg from 93.38 down to 91.13 recent low. The pair is attempting also to build the base at this point, with a clear break above 92.50 required to confirm break above the near-term range and directionless trading, as the gains are picking up strength with the 20 days moving average currently at 91.75 holding the downside protected. A clearance of 92.50 and 92.75. The 61.8 Fibonacci retracement is to open next significant levels 93.00 as a low of 20th of January. Also the figure resistance ahead of our next strong barrier at 93.38, high of 25th of January. Failure to clear 93.38 might signal further range and directionless trading, as the risk remains for a US dollar to run out of the recent steam that came after strong NFP data. It's significant and it's important at this point the dollar to sustain its gains from last Friday that will affect directly the dollar Swiss. Also the possibility of Swiss National Bank acting to support and prevent further strengthening of dollar Swiss might be further supportive for the pair in the short term. Gold is currently in the corrective pullback after recent strong rally of the US dollar on the US data triggered the reversal of the yellow metal. Initially the pair dipped to 1723 zone just ahead of 1716 previous higher low posted on 30th of January, and holding above 1716, 1700 would keep the recent uptrend from 1522 low of 29th of December in play. The daily studies maintain positive tone. However, the pullback now is underway on the overbought conditions and might extend lower, where 20 days moving average currently at 1688 maintains the recent strength, and the reversal above this level would be ideal to resume gains. It's significant that the pair's recent rally regained our initial resistance at 1763, where the recent rally stalled. However, the focus remains on the upside as long as I said, 1688 holds the downside. On the near term, the hourly studies are into negative field, but extremely stretched, suggests that a bounce might occur soon, but yet no signs of any positive structure. The pair is currently, gold is currently testing a previous low of last Friday at 1723. That might directly open levels at 1716 and 1700, which is our next strong support. The crude oil also maintains a negative structure of 103.72 high of 5th of January, as a continuation of lower highs and lower lows keeps the pair in the near term descending channel. Significant was loss of 61.8 Fibonacci retracement of the latest rally from 92.70 to 103.37. That might signal further easing, as and negative short-term studies keep the pressure at the downside, with the latest recovery attempt stalling at 98.00 previous high of 2nd of intraday high of 2nd of January, pardon, 2nd of February, and holding below here keeps the focus at the downside. As we can see on the hourly chart, the fresh easing is now underway. Loss of initial support at 96.00 and 95.43, which is the low of 2nd of February, would signal further extension of the downtrend from 103.72. At this point, break above 98 and around 98.30, 98.20, pardon, then 50% Fibonacci retracement might improve the near-term outlook. However, a regain of levels at minimum $100 per barrel is required to avert immediate downside risk, and refocus levels at 101.20 previous highs of 26th of January and 31st of January.